Today is Tuesday, June 26th. It's time for me to welcome you to Econoday Unplugged. I am Ann Picker, Econoday's chief economist, and with me are Jeremy Hawkins in London and Mark Pender in the U.S. On Sunday, U.S. time, China's central bank, the People's Bank of China, moved to free up more than $100 billion in reserves to cushion a slowing economy and to mitigate the impact of a potential trade war with the U.S. In its statement on Sunday, the PBOC announced it would reduce the reserve requirement ratio for large commercial banks by a 0.5 percentage point, giving them an additional approximately renminbi 500 billion extra to deploy. Reserve cuts for smaller banks are expected to free up an additional 200 billion renminbi. The announcement of the cuts, which are scheduled to take effect on June 5th, came just as it was reported that the Trump administration had decided to restrict Chinese investments in U.S. companies and startups and in sectors from aerospace to robotics, as it appeared to deploy its latest weapon in escalating the trade war with Beijing. The PBOC, it should be noted, has found more flexibility in affecting policy by changing the reserve requirement ratio rather than using their interest rates to affect policy. Jeremy.
Okay, well, I suppose it's all about trade wars at the moment, but as far as the Bank of England is concerned, we saw from last week, it looks as if they're still taking the view that interest rates are more likely to go up than they are to go down. In terms of the BOE MPC then for June, what do we get? Well, there's no change in interest rates, bank rate at 0.5%, or the ceiling on quantitative easing, which is still 445 billion sterling in total. So that very much as expected. They also retained a tightening bias, but there was an important, albeit perhaps subtle, shift in their forward guidance. Now, unlike the Fed, the Bank of England have indicated that there won't be any adjustment in terms of quantitative tightening, so reducing the size of their balance sheet. They had intimated that it wouldn't be until bank rate was around about 2% or so. They've now come out, though, and said that the new trigger for shrinking the balance sheet is going to be about 0.5 percentage point lower at around 1.5%. So it may not mean that much at the moment, but going forwards, it means that as and when we do start to see quantitative tightening, it's going to come about that much sooner than might otherwise have been the case. Also of note from last week, we saw a surprise vote in the sense that rather than the 7-2 in favour of no change, which is what the market was very much anticipating, is a little bit tighter in at 6-3. And we saw, and this is quite unusual, the chief economist, Andy Haldane, joining the mega hawks, McCafferty and Saunders, in calling for an increase in interest rates immediately at 25 basis points. That's been seen by the market, probably correctly, as at least increasing the chances that we will see bank rate going up at the next meeting, which will be in August when they get the next quarterly inflation report. But it's still very much a case, I think, of watching the data. It's far too early to assume that that is a done deal. I should also mention on with regards to the Bank of England, the replacement for Ian McCafferty, who's basically the strongest hawk on the MPC at the moment. His last meeting will be the August one. His replacement, Jonathan Haskell, he was addressing the Treasury Select Committee on his pre-appointment hearings today. He didn't say too much in terms of what he thinks should happen to policy, but he did indicate that he thinks that productivity may well be understated. He also suggested that he thinks pay pressures will remain relatively subdued. So put all that lot together, and it certainly suggests he's going to be a good deal less hawkish than the outgoing McCafferty. So that probably means if he'd been around last week rather than McCafferty, the vote would have been 7-2 rather than 6-3. So he won't be in until the meeting after August, but certainly once we get there, it means that perhaps policy will be a little bit looser than it might have been otherwise. Regards to the Eurozone, I think the main focus for market attention this week will be the EU Leaders Summit on Thursday and Friday. Of course, that was really supposed to be dominated by Brexit, but Brexit's going nowhere in a hurry at the moment. And the UK position paper, which Theresa May was supposed to be presenting, has now been deferred. Rather, the focus is going to be on the thorny issue of migration. Now, differences of opinion between the member governments is certainly nothing new, but I guess they've been highlighted by the arrival of the populist anti-establishment administration in Italy. And now the outcome of what will be a broad-based discussion on what the European Union should be doing about the issue, that could be particularly important now for Germany, as we've got the leader of Chancellor Angela Merkel's coalition partner, the Crystal Social Union. He's also the Interior Minister, and he's effectively threatened to topple her unless more aggressive rules on asylum and migration are agreed upon. Now, we had an emergency summit called by Merkel on Sunday to discuss the issues, and that failed to come up with any concrete conclusions. So it may just be some politicking from within the coalition, but depending on what comes out this week, Merkel's position could be looking at least a little bit precarious. And that clearly would be, good news for Euro. Yeah.
Oh, this is Mark. Sorry to interrupt. Do you see there's a conceptual relationship, I think, here in the U.S. Between the migration or the immigrant issue and also closing or protecting trade. And I have a question now with the immigration issues in places like Italy and also places like the UK. Has that ever transposed to the trade issues, a protectionist actual movement to protect trade?
Well, it can't really within the Eurozone per se, because part and parcel of being in the Eurozone, you're part of this free market. So there's no barriers to trade. So that effectively can't, from a political angle, it's simply a non-starter in the first place. Now, of course, for the likes of the UK, assuming Brexit goes through and we're outside the European Union as of the end of March next year, then yes, it's quite possible. The UK has already, banged the drum with regards to migration into the UK being too high. It could turn into some kind of mini type of trade war. I don't think either the UK or the rest of the European Union would want that to happen, because both sides regard free trade as being extremely important, to economic growth. But it's something that outside of the European Union, yes, it is very much a possibility.
So you can see a separation then between immigrant issues and trade issues.
Certainly within the European Union under current rules, and there's no choice on that. Okay, let me round off quickly then, before I pinch up too much time. In terms of the numbers this week then, for the Eurozone, the big one as ever will be inflation. We'll get the flash HICP data for June. That's due on Friday. And that's expected on a headline basis to be 2% on a year-on-year. That'd be up a tick from last time. But the core rate's expected to go the other way, 1% after 1.1%. And of course, if we get that, then although Mr. Draghi and co have intimated that quantitative easing is going to end at the end of this year for the ECB in the Eurozone, if the numbers don't live up to our expectations, then who knows? We could still have quantitative easing taking place in the Eurozone in 2019. To also mention quickly, we will get the German flash CPI of the day before, the HICP out of the Eurozone, and we'll also get the Economic Sentiment Index on Thursday, which is one of the ECB's major numbers, so always worth a look at. That's my lot.
Thank you, Jeremy. Mark?
Oh, well, it's interesting. Jeremy's talking about the Bank of England and also the ECB and the Fed gets in here too, becoming less accommodative or turning more hawkish. This is at a time now when we're having these trade issues, and these trade issues don't seem to be stimulative. They wouldn't appear to be stimulative, and I think we're beginning to see what could be, if we, in retrospect, the very initial signs of an effect on the manufacturing sector here in the U.S. It's interesting, just an aside, that President Trump, when he's referring to trade, he hasn't talked about services. Now, service exports are very strong for the U.S. This is demand for our U.S. managerial and U.S. technical skills. It's roughly, let's say, about $200 million of trade of exports every month. A third of that is services. So far that hasn't been brought up in all the lists of things that are penciled in for possible tariffs. But we saw in the Philadelphia Fed manufacturing report on Thursday last week, a sharp fall off in the rate of growth in this index, and this is it's very clearly a pivot over the last couple of years or so. This index has been very, very strong since the Republican sweep or the Republican victory in 2016, and then on Friday, Market Economics manufacturing U.S. sample reported the same thing, and the market sample has been the less robust of all the manufacturing samples, whereas Philly Fed has been probably the most robust in the long term. So it's interesting that we see these two forward-looking, even though they're small samples, reports offer the same indication. On Monday of this week, we saw the Dallas Fed. It was mixed. There was very clear slowing, but not in orders, which is probably understandable for the Texas economy and their exposure to energy, and energy prices are high right now. And Richmond Fed, which is another regional manufacturing report that came out this morning, Tuesday, we didn't see this slowing, but this has been this report's been kind of slow all year relative to the other ones. But what we did see in the Richmond Fed report was a spike higher, a very visible spike higher in input costs. And these are very likely tied to tariffs. And some of these reports offer commentary on what their sample tells them, and some of them don't. Richmond isn't one. But the ones that do, the samples are reporting disruptions, delays, all tied to primary metals. And these were the tariffs that have been put in place for the last several months. These other ones we're still talking about. But I think that it's possible that what we're going to see initially in the economic data is a slowing in manufacturing activity and a rise in prices. And by the way, the Philadelphia Fed report shows an unusual traction in selling prices. Now, this means pass-through, and this will eventually pass through out of the manufacturing sector. If it can pass through the distribution system, it'll end up to the consumer. We haven't seen that yet, but that is ultimately the threat. And I'd just like to say one other thing about exports. You know, the U.S. exports $2.3 trillion a year, and with Harley Davidson making this kind of a shock announcement. Really, there's so many. It's an infinitude of possible outcomes, and when you're dealing with trade like this, and the Harley Davidson outcome being such a symbol of U.S. Merchandise, of global demand for U.S. consumer good, Harley Davidson is right at the very top, and they're moving production outside the U.S. So. I think the general assumption would be that you would see more production in the U.S. with these tariffs, not less. So it's a very interesting time. It's a very important time to pay attention to your economic indicators.
I've got to ask you, Mark, in terms of, Ansbury talked about perhaps the PBOC getting a bit worried about impact of trade wars and the like. How much of this is impacting the Fed thinking, do you think, now?
Well, the Fed, Jerome Powell has been has been very cautious on saying, and the other Fed officials as well. And I think maybe that was Janet Yellen's downfall. She went out and she never complained. But so far, the Fed officials have been tiptoeing, sidestepping, really the fundamental issues, and they probably have many or some on the FOMC economists must have very strong opinions on what's going on. We haven't seen those strong opinions being expressed. And perhaps if we do get disruptions, or if we get an inversion of the yield curve, the U.S. yield curve with the 2-year approaching the 10-year, I think that would almost force their hand to really start talking more frankly about what the possibility is.
One quick point, actually, just for perhaps for Anne winds it up. You're talking a lot about the PMIs and so on. Over here, there's a study undertaken by the Bank of England. It goes back a few years now, but of note, and particularly with relevance to that, the most highly correlated indicator they found with global, so world GDP, was the export orders index of the global manufacturing PMI. So I think perhaps it highlights the fact that this really is one of the components of the PMI surveys, which is well worthwhile looking at if you are starting to get concerned about global growth prospects.
Well, that's right. I mean, I think whatever the expectations are for trade, it's not an unreasonable assumption to assume or to guess that there will be a net reduction or a net slowing in global trade. Is that what that index is showing?
Well, it's starting to go that way, I think. I think, as you say, it's early days yet, but clearly if things continue to snowball as they are at the moment, that particular index, I think, is going to become one of the key instruments or indicators that markets will be watching going forwards.
Well, get it on our summary tables.
Indeed.
Thanks, guys. Until next week.